We've all heard of inflation. It's constantly getting mentioned in the news, on the BBC, by politicians and economists, and even people down the pub. But here's the scary part. 95% of people don't truly know what it is, what causes it, or how it's slowly draining your wealth every single day without you realising it. So in this video, I'm going to break down everything in the simplest, clearest way possible to show you guys how broken the financial system really is and why it's so important that we beat inflation. Now, before we get into it, this video is intended for information and entertainment purposes only. It should not be considered financial advice. Any reference to financial products, investments, or services are general opinions and are not tailored to your personal circumstances. When investing, your capital is at risk, and you may lose some or all of your investment. Past performance does not guarantee future results, and please always do your own research. But with that disclaimer out of the way, let's get into it. So inflation, at its most basic level, is just prices of everything going up. So stuff costs more, your rent, your food shop, your coffee, your car, your energy bills, and so on. But this is not to be confused with temporary price increases caused by things like supply shortages, geopolitical conflicts, and natural disasters. When petrol prices spike due to a war in the Middle East, that's not inflation. When avocados go up because of a bad harvest, that's also not inflation. That's just naturally occurring price volatility due to supply and demand. Real inflation is the continuous price rise of absolutely everything. This gradual price rise is not because things are becoming more scarce, but it's because the number of currency units in the system are increasing. Governments and central banks like the Bank of England or Federal Reserve in the US literally create money out of thin air. And when you have more money chasing the same amount of goods and services, prices have to go up. For example, if everyone suddenly had £1 million added to their bank accounts tomorrow that the government printed out of thin air, you'd think that we'd all be rich, right? Wrong, because the cost of a loaf of bread would need to be more like £100 to fairly represent all of this new money floating around in the system. Money itself becomes worth less because there's more of it in circulation. And that's effectively what inflation is, but it's not natural. It's a myth that gets repeated all the time, that inflation is just a natural and necessary part of a growing economy. The Bank of England even target a 2% inflation rate, so it makes it feel normal that prices rise over time. But I can tell you, it isn't. Inflation is not some unstoppable force of nature. It's caused almost entirely by governments and central banks increasing the money supply. So let's think about it. Prices don't rise on their own. If the amount of money stayed the same, but productivity increased, technology improved, and more goods were being produced, prices would actually go down, not up. This is because efficiencies are achieved through experience, and therefore production costs would actually reduce as time goes on. For example, if we look at Tesla, when they first started as a company, a lot of trial and error was necessary to produce their first cars, because they hadn't done it before, and they were also trying to incorporate new innovation and technology. This process is incredibly costly, but over time their efficiencies have improved, and now the price of their cars are coming down significantly as time goes on. So this reduction in price is called deflation, and it's actually the natural state of how things would be if we had a currency with a fixed number of units. But here's the issue. Deflation, while being beneficial for savers, makes it harder for borrowers to repay debt, because the value of money is going up over time. And since governments and central banks manage large amounts of public debt, with the UK national debt currently sitting at over £3 trillion, they tend to prefer inflation, which effectively reduces the real value of their debt over time. And this is one reason why modern financial systems are structured in this way, that tend to favour inflationary policies. They make debt more manageable for both governments and borrowers, but often at the expense of savers. Now, you might be wondering, how do these governments and central banks actually print the money? Well, this is where it honestly gets a bit crazy. So one way that they pump money into the system is through something called quantitative easing, otherwise known as QE. This is when central banks literally buy their own government debt off the open market using newly created digital money. They don't get this money from taxes or from borrowing. Nope, they literally create it digitally out of thin air. The Bank of England's website literally says the money that we use to buy bonds when we're doing QE did not come from government taxation or borrowing. Instead, like other central banks, we can create money digitally in the form of central bank reserves. Now I know this all sounds insane, but it's true. But the next question you might ask is, why is all of this necessary? Why does it have to be so complicated? Well, QE is a tool that central banks use to lower interest rates and stimulate the economy, as they like to call it. Now, to understand how this works, we need a little bit of background about how government debt and the bond market works. So governments borrow money by issuing investment products called bonds, which trade on the open market and can be purchased by individuals, businesses, and even other governments. Each bond has a face value of, let's say, £100, and it pays a fixed income of, let's say, £5, and that results in a 5% yield. However, because bonds trade on the open market, their prices can fluctuate, which causes the yield to rise and fall. So during quantitative easing, central banks buy large quantities of these bonds, which increase the demand, pushing the bond prices up, which in turn reduces the yield. So if that bond, which was originally trading at £100, is now at £150, but it still pays out that £5 per year income, the yield has now dropped to 3.33%. And now that bond yields are down, it provides a mandate for central banks to lower interest rates across the board. So QE isn't the only way that governments pump money into the system to create inflation. Government schemes and incentives are also a big culprit. Some of the best examples are the Eat Out to Help Out scheme during COVID, the furlough scheme also during COVID, the Help to Buy equity loan scheme for first-time buyers trying to get onto the property ladder, or basically any infrastructure project backed by public money. It may feel like you're being helped out, and sometimes you can use this to your advantage, but overall, it all contributes to inflation. Now, hopefully at this point, it all somewhat makes sense, but now we need to dig into who benefits and who suffers at the hands of money printing and inflation. Well, the simple answer is it's all designed to benefit governments and give them more flexibility to operate. Governments win because lower interest rates mean that they can borrow money cheaply, making it easier to service their massive debts. It also makes it cheaper for them to fund new projects, as they can now borrow even more money at this cheaper rate. But there are also other members of society who also benefit from inflation and lower interest rates. Those being people who own assets. Whether that's property, stocks, gold, Bitcoin, fine arts, or for the most part, anything that's scarce and has perceived value. QE pushes new money into the financial system, which as a result inflates the value of all these assets. This asset appreciation can also escalate as money shifts from bonds to these other asset classes. Because when interest rates are low, bonds don't provide attractive returns anymore, so investors look for higher returns elsewhere, often in riskier assets like stocks, property, gold, Bitcoin, and sometimes very speculative assets like collectibles, crypto, and NFTs. As well as this, since money is now cheap to borrow, even regular people and companies start buying up assets with borrowed funds, which, as you can guess, pushes asset prices up even higher. So if you already own assets, in theory that's great, as your assets will hopefully increase at the same rate that the currency is being debased. But if you don't, you'll get completely screwed by the system. If you're working a normal job, renting, saving a little bit each month, you're going to fall behind if you don't have any assets. Wages don't rise like asset prices do, so housing becomes more unaffordable. Buying a car outright is too expensive, forcing you to borrow money to finance the cost. Even potentially buying tools to start a business will become more and more difficult over time, as your money buys less and less the longer that you hold it. This is one reason why young people today are struggling so much to get on the property ladder, while older generations saw it as a basic milestone. This isn't just bad luck, it's by design and a systematic failure. Now, with the principle of inflation grasped, to start getting on top of it, we need to first find a way to measure it. But here's another twist. Governments use something called the Consumer Price Index, or CPI, and that metric is completely flawed. The reason for this is that CPI is constantly changing what it measures. So it tracks an average basket of goods that people buy, but the items are often swapped out when prices rise, as people try to cut back on their everyday spending. As a result, making inflation look lower than it really is. For example, let's say in 2020, an average basket contained high-end mature cheddar. But now, due to inflation and wages not keeping up, people are forced to cut back on their expenses, and now the average person is buying a much cheaper, more basic cheese. This basic cheese now makes it into the CPI basket, which distorts the data and doesn't reflect real inflation. Because of this, the only way to measure true inflation is to track the rate at which the money supply is increasing. But luckily, we can do this by looking at something called M2. So M2 is a measure of the money supply that includes currency in circulation, checking accounts, savings deposits, money market funds, and other liquid assets that can quickly be converted into cash. This comparison chart of CPI versus M2 in the US demonstrates it perfectly. So over the last 10 years, M2 is up around 240%, while CPI is up just 65%. That difference is obscene, and hopefully it demonstrates that CPI cannot be trusted as a measure of inflation. So now we have a way of measuring inflation using M2. What can we actually do to try and beat it? Well, step one is you have to get yourself into a position where you can save some money. To put it simply, you need to spend less than you earn. Then step two is do all you can to start accumulating assets that will increase in value at the same pace, if not more, than the growth of M2. Now, obviously, that is much easier said than done, but some examples could be stocks, property, gold, Bitcoin, or basically whatever it is you understand and believe will outperform the rate of currency debasement. Personally, I like and use Bitcoin. This is because it's a fixed supply asset of 21 million. It runs on a decentralized network, which makes it inherently resistant to manipulation. It's also incredibly accessible, so you can buy tiny fractions of a Bitcoin for less than £1. And it's been the best performing asset over the last decade. Although over the short term, it can be incredibly volatile, so it's really worth doing your research. Now that covers everything for today. So if you found the video helpful, please smash that like button down below. Let me know how you're trying to beat inflation down below in the comments. And make sure to hit that subscribe button to stay up to date with all of my latest content. But if you're curious about why I believe in Bitcoin so much and want to see how I think it stacks up against other asset classes, check out this link on screen now to my video breaking down how I would invest in 2025 to beat inflation. But with that said, take it easy and enjoy the rest of your day.